Nice to be back with you. I've enjoyed the last couple sessions up in Lake Arrowhead. Kate asked if I'd get online with you and talk a little bit about what's happening out there. And this is a good day because we got the April employment numbers. So if you haven't been in a complete state of panic, 20 million job lost, unemployment rate of 14.5%. This would be a good day to start panicking. But fortunately, you're here with me. Look, as shocking as these current numbers are, the question isn't what's happening right now. We get that. The question is what's going to happen next. And of course, the debate, as always, among economists has boiled down to a combat of letters. Are you in the U camp, the V camp? If you're a real pessimist, the L camp, the W camp, I don't know, the Q with an ampersand camp, I don't know. All sorts of people have to come up with their own level of things. Now, it is certainly intriguing when we start talking about this because it's funny how just a few weeks ago, what a different world we existed in, right? When I was with you guys last fall, there was long conversations about how we weren't going to have a recession, that things were pretty good. We're ticking along at a good pace. And, you know, this was, of course, I was being fairly contrarian relative to the broader opinion that the U.S. economy was about to enter a recession. What's interesting, as we got through the end of the year, all these fears about Chinese trade wars, real estate collapses, inflation, interest rates, all these things had faded away. And interestingly enough, you know, in February of 2019, almost 80% of the economists who contribute to the Wall Street Journal Next Recession poll said we were going to have a recession in 2020. By February of this year, that percentage had dropped to 11%. So everybody got really confident. And I still remember when I gave, this is my end slide for one of my presentations I gave. And you can see down here in that little lower left corner, top risk, this virus thing. Oh yeah, we have this virus thing. Little did anybody fully understand just how dramatic this was going to impact the US and indeed the global economy. Wow. Now, here we are in 2 short months, about 3 months, excuse me, and we're in a recession. We know that. The Q1 numbers came in negative 5%. Q2 will again be almost assuredly one of the worst quarters for growth we've ever seen in the United States. Now, you know, we get it. Like I said, we understand the now. We have the global pandemic. I can't even keep up with the number of people afflicted, the number of deaths. Across the globe, we've been dealing with unprecedented shelter-in-place rules, closing an enormous part of the economy, millions of people, as noted, thrust into unemployment. The big question, what next? Now, going back to the letter combat, right now, the dominant opinion in the opinion world, as the case may be, is you. You got folks from UCLA to hedge fund managers to the OECD saying this is nasty. It's going to take years for us to get over this. 40% decline in GDP in the second quarter. Worst downturn since the Great Depression. If you listen to the governor's speech, I think it was yesterday or the day before yesterday, he went on and on about how this is going to be significantly worse than the Great Recession. Wow. Lots of negative rhetoric out there. And this is just 2 sample forecasts I grabbed. On the left is B of A, on the right is UBS. And these are really scary numbers. Take, for example, the B of A forecast. They're talking about from the fourth quarter of last year to the first quarter of this year, an amount of economic output declines, somewhere in the 10.5% range. Now, again, to put this in context, the entire decline in economic output during the Great Recession was about 5.5% in real terms. So you're talking here substantially worse, twice the level of economic output decline, and not getting back to Q4 levels of output until the end of next year. The UBS forecast for unemployment, equally grim. They're talking about heightened unemployment through the course of this year and unemployment not getting back to more normal levels until the end of 2022. This is scary stuff. And if you look at this in a vacuum, the only thing you should be doing right now is battening down the hatches and getting ready for a long, long, hard slog trying to get through this mess. But I would also remind everybody that when it comes to any kind of public conversations about the economy, hysteria is the new normal. Again, in January of last year, 80% of economists said we were going to have a recession, driven by real estate collapses and the Chinese trade war that was going to demolish U.S. manufacturing and all the problems we have in our labor markets and so on and so forth. Every time anything happens, everybody goes to the worst possible case scenario, and then they go a step farther. It's just how these conversations have gone. You can't take this stuff seriously. We have to keep in mind that hysteria, again, is how everybody has these conversations. Now, like I said, there's no doubt we're in a recession. Eventually, they will date this as a March start. And it isn't to say this is insignificant. This is by far and away the most dramatic shock to hit our economy in well over a decade. But that doesn't necessarily immediately lead us to believe this is going to be a long, tough slog the way the Great Recession was. And to start this conversation, I'm going to put my professor hat on just a little bit and talk a little bit about what a recession is in the first place. You have to kind of have a sense of how recessions happen to understand what is and isn't happening right now. Now, look, growth is the default mode of any economy, and that's because an economy is made up of millions of people trying to do better for themselves, for their families, for their businesses, whatever. They're out there working hard, and the collective result of everybody working hard to get ahead is that the economy grows. Now, while the economy is growing, there's always winners and losers. There are always hits as well as the positives. We know that the rise of some sectors of the economy hurt other parts of the economy, or you have parts of the U.S. growing well and other parts that are seeing diminished population bases and so on and so forth. But none of these are big enough to, if you will, offset the overall growth trajectory of a U.S. economy or any economy. But every once in a while, something different happens. A recession-causing event, a shock to the economy that is large enough to actually unbalance the system. That is to say, it hits, and as a result of hitting, the economy no longer grows. Now, what kind of characteristics does this shock have to have? Well, three. One, obviously, it has to be large, has to be very large. Two, it has to be rapid. The economy can adapt to slow changes. Changes that create recessions have to be quite rapid. And the third thing, and the one that is probably most critical to this discussion, is the shock that hits the economy must be sustained, right? Look, if things hit and then go away, you weather the storm and you move forward. You have to have something that really stays in the system for a while. And the reason that's critical is because when the shock is large, rapid, and sustained, it sets off a negative feedback cycle that intensifies the situation. For example, you have a collapse in one part of the economy, a bunch of people are released, too many be quickly absorbed by the rest of the economy. As a result of that, those families stop spending money, and that puts stress on other parts of the economy. And those other parts of the economy start laying off people, and they in turn become stressed and start spending less. And you get this kind of feedback effect that intensifies that initial shock to the system. Large, rapid, sustained. Now, there's one other thing that you have to think about when it comes to recessions, and that has to do with how labor markets operate. Employment in recessions is a lagging indicator. That is to say, it happens last. It's the thing that comes in at the end game. And the reason for that is we have to understand that businesses don't like to hire people, and they like to fire people even less. It's an expensive process either way. It's expensive hiring people because it takes time to find that person and get them trained and make them useful. And by the way, it's equally hard to get rid of people because you got severance packages and all the things you got to deal with. You have to deal with the loss of someone who's spent a lot of time and effort learning how to work within your company's framework. And of course, last but not least, the shock to the psyche, if you will, the morale of the rest of your workers is pretty bad. So no company likes to fire people. They don't want to, and it's the last possible thing they do. So it's a lagging indicator in all these downturns. Now, if you think about the Great Recession, it's worth using this because it's such a beautiful example of a really nasty recession. Why did it happen, and why was it so rough on the economy? Well, the Great Recession didn't happen because real estate collapsed. That's kind of this idea. Well, real estate went down and we had a Great Recession. No, the reason real estate came down so hard is because it went up so hard. We have to remember the Great Recession occurred on the back end of a 6-year, $15 trillion subprime bubble. It was without a doubt the greatest financial fraud ever perpetuated in the history of the United States. Wall Street developed this insane thing called the asset-backed security, where they promised investors that, wow, we can hand out money to anybody, anywhere, at any time with absolutely no underwriting. And you know what? You are protected because of our cool new financial layering system. It was unbelievable fraud. I mean, it was just, but anyway, we don't need to talk about that. Point here is that $15 trillion massively inflated parts of our economy, and candidly, in a temporary fashion. You had the housing market go crazy in terms of prices and overproduction. You had consumers taking all that credit and equity to heart and overspending. You saw the U.S. economy, saw the savings rates go down to the lowest we've ever seen them, even as the U.S. economy started opening up close to a 6% trade deficit. In 2006, our economy was completely out of whack in so many different ways, generated by that $15 trillion bubble. Now, when everything started to fall apart at the end of 2006, it was only a function of time till it turned into a recession. Things were so out of whack. And when the subprime bubble collapsed, the housing market collapsed behind it, consumer spending collapsed behind that, and it ultimately, the U.S. economy lost millions of jobs in real estate, finance, construction, and a little bit of retail, and they lost those jobs critically, permanently. Those jobs were not coming back short of another $15 trillion bubble. So it was a really nasty recession. It was long-term, not just the 6 quarters and the 5.5% decline. In fact, when you look at actual output relative to potential output, the U.S. economy didn't fully heal from the Great Recession until about early 2015. It was nasty. It was a nasty downturn, but again, driven by this enormous shock of the collapsing subprime bubble. Now, back then, I mean, if you think about today and why people are so freaked out and why they're predicting a worse shock than the Great Recession, then you have to start with the idea that looking at the employment numbers shows us it has to be worse. I mean, look, back then unemployment got to 10%. We're already at 14.4%. Any pessimist would say this is going to be nasty. And we know that, of course, when unemployment goes up, it takes a long time to come down. So yeah, I get it. Optically speaking, when you're looking at this one data point, employment, unemployment, it's scary. Clearly, this is going to be worse than the Great Recession. But as with everything in macroeconomics, in fact, everything in life, context is king. And you can't draw one comparison between the unemployment rate in 2010 and right now in 2020 and say those two things, because one's bigger than the other, therefore, ergo, this is a worse cycle than the last one. Right off the bat, a couple things that immediately stand out. Take a look, for example, at when we're seeing this surge in unemployment. In every past recession, the peak of unemployment rates occurred after the recession came to an end. This one's peaking at the start of the recession. It's not the same. And in fact, in a lot of ways, that is an incredibly important thing to keep in your back of your head. Those jobs during the Great Recession were lost, and they were lost permanently. And it happened after the huge negative shock to the system. It was the very detrimental consequence of the huge negative shock to the system. This time around, unemployment is very high at the beginning. And of course, we know unemployment is being driven this high, not because these businesses are failing, not because there isn't demand for their services, but rather, quite differently, because they're not allowed to sell their services and goods to people because of public health mandates. And public health mandates, to be clear, are not long-term. These are functionally temporary. So as opposed to this being a consequence of something dramatic happening, quite the opposite, this is actually the driving factor. Now, it sounds like a trite point to make. Oh, it's a cause versus an effect. But it's an important point to make. Because if it's a cause, then you can't look at it as the same as if it was an effect. It's a completely different type of metric. And if you want to see that in a little clearer way, take a look at the right-hand side of the screen. And I literally downloaded these numbers just an hour ago. This is from this morning's labor report. Yes, if you look at the numbers, it's pretty dramatic. In April of 2019, there were 5.4 million people unemployed in the United States. In April of this year, 22.5 million people, 17 million more people unemployed on an April to April basis. However, everybody claims that they're temporarily laid off, not permanently. In fact, if you look at the number of people who claim to be on temporary layoff, that increased by 17.3 million on a year-over-year basis, larger than the number of people actually unemployed. And take a look at up above. This is the share of people who are unemployed who are on temporary layoff. 80% of these people are on temporary layoff. It's never looked like this. If you go back to 2010, the vast majority of people said, I'm permanently lost my job. My company's out of business. I am never getting my job back. This time around, most people were like, I'm just waiting until my company is allowed to open up again. It's not the same thing in any way, shape, or form. This is not a typical business cycle. The lessons of the past are not applicable here. You can't just look at these numbers in the context of a VAR and say, anything that's happening today is comparable to what happened in the Great Recession or the tech downturn or the commercial real estate downturn of the early 1990s. It's not. The shock happening today is very large. It's very rapid. Came out of left field. No one was anticipating or expecting this. But in no way, shape, or form is it sustained. These public health mandates stay in the system only until we get control of the virus, which, by the way, is happening already. And the vast majority of these people who've lost their job are not in panic mode. Yeah, they may be hurting a bit, but they're not panicked because they have every confidence that they're going to go back to the job they had a month ago. There's no reason to see a massive structural shift in the structure of the U.S. economy. Now, I'm not saying that this is harmless, that it happens and goes away. Yes, clearly we're building up damage. But the damage that's occurring to the economy, back when the Great Recession occurred, remember the damage to the economy came from the collapse of the $15 trillion bubble and the collapse in the housing market, the collapse in consumer spending, again, led by the collapse of that bubble. This time around, the damage we're talking about, the damage that will determine what the shape of the recovery is going to look like, is actually not a function of these mandates. Rather, it's a function of what happens while the mandates are in place. As time goes on, people aren't earning money and they're going to fall behind. Businesses aren't able to earn a profit and they're falling behind. And the farther they fall behind, the larger the damage builds up in the system. Now, one of the things that every forecaster, including myself, has to start with under this sort of circumstance, this is not a typical business cycle in any way, shape, or form. The kind of damage building up in the system right now, we just don't really have a good sense of how it's shaping up, how much damage is actually occurring. Thus, every forecaster should immediately be on alert to say that as dramatic as the numbers are right now, I have to equally appreciate that the lessons of the past couple business cycles are simply not applicable here. They just aren't. But unfortunately, in an era where hysteria is the new normal, no one's acknowledging that. No one's sitting back and going, hey, listen, guys, we can't just say unemployment's high, it's going to take a long time to come down. Because typically unemployment comes up, it takes a long time to go up, and then it in turn takes even longer to come down. This time it went up almost overnight. Thus, there's no reason to make the same assumption that it's going to take a long time to come down. We just don't know. So yeah, look, if you want to think about this from a pure cyclical perspective, there are multiple outcomes. And it all depends on how much damage builds up in the system right now while the economy is closed down. And to make this point a little bit, because it's a fuzzy point and I have trouble trying to get people to understand it, but let's do a little bit of a mental experiment. Imagine for a second, 2 weeks after the shutdowns occurred, some genius came up with a cure for the coronavirus. Just came up with some magic potion and we drink it and it goes away. I think we can all agree that had that cure arrived, everybody would have gone back to work and this would have been a non-event. This goes back to the heart of the point I'm trying to make. The job losses we're seeing right now are inherently temporary. When the mandates are lifted, vast majority of people are going to go back to work. Now, how many go back to work is going to depend on how much damage is done while the economy is shut down. If it's a lot of damage, Great Recession type scenario. That is to say, we fall, we continue to fall, and it takes a long time to get back. If the damage isn't that great, then you might have a 1990s mild downturn where we fall hard, but get back on track relatively quickly. And of course, in the best case scenario, where almost no harm is done in the short run, and in fact, only thing these mandates do is create a whole bunch of pent-up demand, well, that's a natural disaster type scenario. You think about an earthquake hitting, or say when Hurricane Andrew demolished the Miami-Dade area. These are economies that took massive hits in the short run, but very quickly bounced back. In the context of rebuilding and people going out and catching up on life, you actually would see the economies grow faster than normal before they get back into a normal growth path. This is this kind of N shape. And yeah, it is a reasonable possibility. Now, we just don't know. All three of these things could pan out. Most forecasters screaming end of the world out there are assuming the worst case scenario plus some. Now, how might you determine what kind of outcome could actually occur? Well, from our basis, we think you can boil the answer down on the basis of 5 simple questions. How long will the shutdowns last? How deep are the closures? In other words, how much the economy is going to get hit? How healthy was the economy in the first place? What is the government doing in the meantime? And number 5, will there be a permanent shift in post-virus spending? In other words, are people going to be so scarred they're not going to behave the way they did pre-virus? These are all important. The shorter this is, the less the harm. If we think about the depth of the downturn, I realize the metrics are pretty scary, but even with an unemployment rate of 14.5%, it's worth noting 85% of people are still employed. They still have jobs. They're still earning money. Remember, if this only hits this part of the economy, here's the lost income and revenues. But on this side of the economy, there's a bunch of people who aren't able to spend. And that's pent-up demand. Which of these is greater, the pent-up demand or the lost income? That will tell us how much damage occurring. Well, again, that's going to be important to thinking how much damage is occurring right now. How healthy was the economy? That's obvious. What is the government doing to intervene? That's obvious. And will there be a shift in behavior? So let's go through these questions pretty rapidly and see what the answers are. First of all, how long? Well, China is the best case scenario on this because they're way ahead of everybody else for obvious reasons. This is where the virus began. And their experience suggests it's about 3 to 4 months to get over this thing. The U.S. looks a little grimmer than most places. It doesn't look like the number of new cases is coming down. But I would also point out to everybody that that weird shape is in part driven by the fact that our testing lagged so badly because of really the poor planning that was going on. Nevertheless, you still have this idea that this is about a 3 to 4 month exercise for us to truly get over it. And I realize there's some important assumptions in there, but let's just stick with that 3 to 4 month thing. And again, if you look at China, you can see that from the economic data. Goldman Sachs has some really nice high frequency data out of China that unfortunately smaller shops like ours don't have access to. So I just use their data. But again, if you look at industrial activity, it took them about 3 months, a little over 3 months to get back, at least according to the consumer spending data. On that particular basis, you're talking about 4 months or so to get back. So not that bad as the case may be. So again, a 3 to 4 month exercise. Now here in the United States, can everybody still hear me okay? Because I'm frozen a little bit, good, okay. Now here in the United States, this is the New York Times tracker. Again, it continues to look like things are turning the corner. We've been saying for a while, mid-May for partial reopening, which again, listening to governors across the United States, they seem to be moving into that particular direction now. We've got some announcements of some things happening here in the United States. However you look at it, it's pretty clear that April is by far and away the worst month. May will be better, June will be better yet. And we look at Q3 being, as an economy, largely, not perfectly, but largely reopened for business. Now, I appreciate that there's a lot of people nervous about a second wave of this virus hitting the United States and having to shut down the economy. And it makes sense, it happened once. But again, in economics, there's a concept which you all learned from your economics professor called the learning curve. We all have to understand that the reason this was so bad the first time around is most of the developed world sat around on their hands whistling Dixie while this thing was already creating havoc within our economy. As we now know, as our president was walking around telling everybody that things were under control and the virus wasn't here and there wasn't any kind of problem, well, guess what? We already had people dying of the coronavirus here in California. You only get one Pearl Harbor, okay? You get one surprise attack. That's it. Now, we have lots of testing that continues to be up and running. We have doctors on high alert. Everybody understands you got to wear a mask. You got to be careful. We live in a different world now than we did 2 months ago. And it's a world under which it's just not the same. There's not the same potential for this thing to get out of control. There just isn't. And candidly, there's another element of this that I'm not an epidemiologist, but every time we start doing these tests of the general population, we find lots of people have been exposed to this and have been completely asymptomatic. Now, again, what that means is there's a lot more people out there with these antibodies that would help them stave off the chance of another disease, if you will, another case of the disease. All this suggests to me we should be able to get over the hump as long as we're careful. I don't see any major resurgence in the near term outside of the relatively limited possibility of some sort of major mutation, which turns this thing into some sort of completely different killer. So far, so good on that particular front. Now, how deep? Now, besides the employment data, it's worth noting we have almost no information for April right now. The auto number came out in the first couple of days of the month, and that was, of course, understandably grim. But beyond that, we don't have a lot of information. We did get, of course, our Q1 number, or negative 4.8%. We know that retail sales and industrial production dropped off in the first quarter, but we only had a couple weeks of March that were actually in this lockdown type situation. But if you look at these employment numbers, if you think what's happening out there, you can get a good sense of how deep this is getting into our economy right now. Um, it boils down to this. What we've been looking at is claims for claims for unemployment, job losses by sector. And what we can say is, while the job losses are particularly high, we have to remember most of the job losses are coming out of sectors that employ lots of low-skilled people, restaurants, hotels, entertainment and recreation. These are sectors that don't pay a lot of money. That's critical because what it suggests is that the income hits, the output hits to the U.S. economy are substantially smaller than the employment hits. So yeah, I get it. The unemployment rate is now 14.5%, but that doesn't mean the overall economy is contracting on the basis of 10 to 12%. It's less than that because overall, a lot of these people are coming out of relatively low productivity sectors. Now, when we look at the numbers, and we did some basic simulations on this, we think the initial hit to the economy from these mandates is about 8% of the economy. Now, over time, that will grow because of supply chain effects. Eventually, that 8% of the economy is not buying inputs, and that will hit wholesalers and eventually manufacturers and down the line. It'll get through the supply chain. But that takes months to kick in. At the front end, this is about an 8% hit to the economy. And overall, that means that 90% of the economy plus is going to continue to operate. And that's important because what it suggests is lots of people are making money who aren't able to spend it. Now, if you want to think about that balance between, if you will, people being hurt and people being with pent-up demand, the best number we can come up with is the savings rates. Now, we have this data through March. This is that the information here. And the March data was amazing. We had a 13.1% savings rate in the United States compared to the 8% we saw in February. Now, to put this in context, this is the second highest savings rate ever seen in the US, ever. And like, for example, typically this happens because of some sort of weird anomaly. Something happened in the 1970s that caused it to go through the roof for 1 month. We saw that spike back in 2012. By the way, that was right before the income tax cuts that occurred during as part of the stimulus package for the Great Recession went away. You saw massive payouts in corporate America, which is what caused that to spike for one particular month. This time around, this number is sharply up in March, will almost assuredly be just as high in April. And it's all driven by the fact that there's lots of people out there making money who can't spend it. And in fact, I'm guessing a lot of people on this call have probably seen a surprising surge in your checking account over the last few weeks. It's amazing when you're forced to stay at home, what that does for your personal balance sheet. Now, again, that's important because, yeah, I get it. Some people are suffering. Some workers are suffering. But there's a lot of other people out there who just sticking that money in, and they're chomping at the bit, ready to get out there. This suggests, yet again, not a big hit to the economy. Yes, some people are suffering, but on the other hand, there's other people putting that money away, and the balance of one to the other is larger. That pent-up demand is larger than hits right now. How healthy was the economy? Well, this has been an ongoing part of my conversation with your group over the last couple of times I talked. The answer is, despite all the miserablism and the screaming pessimism, the economy is in great shape. Growth hasn't been all that exciting, but fundamentally speaking, the healthiest economy we've had in 30 years. The savings rate prior to this was up to 8%, not only substantially higher than that bottom we hit before the Great Recession, but really getting us back to where we were in the early 1990s. We have seen wage gains, real wage gains, both in terms of median and average for workers across the United States. Over the last couple of years, the greatest pace of earnings increase have been for workers who don't have a high school degree, because labor markets have been so tight. It's giving lots of people opportunities to earn money. Financially speaking, unlike before the Great Recession, where the financial obligations ratio was the highest it has ever been, despite relatively low interest rates because of the crazy amount of borrowing, over the last few years, because of constraints, particularly on mortgage lending, the financial obligations ratio is at a record low level. And in fact, remember, the financial obligations ratio is a percent of household income spent on credit card payments, auto payments, house payments, stuff like that. Now, a lot of folks will go, well, that's maybe true for the top 10%, but everybody else is suffering. Well, again, no, that's not true. On the left-hand side, we can see the ratio of debt payments to family income. You have the median on the left, and you have the share of households spending more than 40% of their income on debt on the right. And then what you can see is for every income level, the debt burdens on American households right now are not only lower than they were in 2007, they're substantially lower than they were in 1998. We are actually a fairly resilient consumer sector right now across the board. And I'm sure you probably heard at least 100 times in the last month and a half about how all these 80% of Americans or 70% of Americans can't scrape together $400 for an emergency. You've all heard that, right? There's not an economist in the world who actually knows what they're talking about who believes that number. It's completely bogus. It's just wrong. And yet it has become conventional wisdom, despite the fact that it has been discredited on 100 different occasions by 100 different people. I don't know why we insist on believing a falsehood, but that's the world we live in. It's just not true. Labor markets, as noted, incredibly tight. I know there's been a slowdown in employment growth over the last few years, but then again, unemployment rates are at a 50-year low prior to this mess. In fact, over the last 2.5 years, the biggest problem in the U.S. has been labor scarcity. For 2 years, the number of job openings in the U.S. has been greater than the number of people looking for work. There were lots of companies desperately seeking people before this happened. And while I appreciate that some companies, some restaurants, some retail will not come back, like we've heard Neiman Marcus is in bankruptcy, they'll be shutting stores down. I get that. There is going to be some residual damage. But remember, those people who are being released into, without a doubt, one of the tightest, most labor-scarce labor markets the United States has experienced really ever. Yet again, this is helpful for things. Real estate. I used to have respect for Zandy. He's at Moody's now. The guy was bright during the Great Recession. He had good things to say. Moody's came out a couple weeks ago with some forecast saying, if the closures stay in place till June, 15% of people out there are going to be foreclosed on in terms of their homes. That's worse than the Great Recession. No. The Great Recession saw so many foreclosures, not because the recession was bad, but because of the $15 trillion bubble that hyperinflated housing beforehand. This is not that housing market. This is rock solid. Over the last decade, the median credit score for a mortgage borrower has been above 750. That's the best it's been. The equity share of residential real estate at an all-time high level right now. Overall debt burdens on American households, as noted, at an all-time level. If you look at the cost of housing as a share of income, whether it's owned or rented, actually the share of cost-burdened households, housing cost-burdened households, has been falling for a decade. This is not a fragile housing market. And even on the private sector debt market, everybody's screaming end of the world. Financial markets are going to see problems worse than what they experienced through the Great Recession. Again, screaming, hysterical, hyperbolic, over-the-top claims without a shred of basis in fact. Instead of being at this peak of overall debt to GDP ratio, for the last decade, debt to GDP ratios have been coming down. And on the right-hand side, this is commercial bank delinquencies in the United States. Pay attention to real estate problems. Real estate delinquencies started to rise in 2006. And then, of course, when the recession began, they absolutely exploded. Well, right now, delinquencies for real estate are at a record low level. Again, we're coming into this rock solid. There is none of this beginnings of problems that precede major market meltdowns. Nothing here suggests any kind of major displacement within financial markets. As for manufacturing, well, like manufacturing is already struggling. They're getting beaten up a little bit in this. But most of the slowdown, a lot of the slowdown in U.S. manufacturing was, believe it or not, driven by oil. It's funny, one of the things that popped out recently, I probably saw this about 2 weeks ago, a truly shocking number on the WTI exchange, Oil was negative $40 a barrel. Now, that negative number was less of a consequence of the current situation and more a consequence of the broader situation. The broader situation in oil is very simple. We have been dealing with a massive glut in oil production for 4 or 5 years now, led largely by massive increases in the U.S. oil output. Over the last few years, U.S. oil production has been absolutely collapsing. Oil investments has been collapsing because we have too much oil on our hands. No one's investing in it. Now, I get it. Oil prices are way down now because no one's driving, and thus refineries aren't operating at all. They're just trying to maintain until they wait for demand to start to pick up just a little bit again. But this isn't going to hurt the U.S. economy very much, in large part because it's really hard to kill a dead man. There wasn't much to collapse here. Investment was already at a record low level because they weren't doing anything. So again, I'm not really worried about this. And trade, even here, there's some relatively good news. The March numbers came out for imports and exports, and they were ugly. Yeah, there's a lot of disruption in global trade right now. Not surprising. That will continue for a couple of months. But again, one bit of good news here is that the U.S. has already shown itself to be relatively resilient to global trade trends. Look, over the last year or so, we've been dealing with this Chinese trade war situation. Imports and exports barely budged. Overall impact on the U.S. economy, almost negligible. Yeah, it's a hit, but not that big of one. Nothing I'm terribly worried about. Number 4, what is the government doing? Well, here yet again, this is nothing like the Great Recession. For the first 6 months of 2008, when we were already in a recession, a lot of economists were debating whether or not there was a recession. By the end of that year, we finally got it. Yeah, this is a nasty downturn happening. And they started putting some policies in place, but it was relatively slow. It was, of course, being interrupted by the ferocity of the election going on. And when Barack Obama won, we have to keep in mind that Mitch McConnell said out loud right afterwards, his primary issue with the U.S., with the new president and the new political situation, he said it out loud, my primary goal right now is to make sure Barack Obama is a one-term president. He didn't really care about helping the economy. He only cared about a political win, trying to get this guy out of the office. As a result of that, we had a limited fiscal response, and it came late in the day. This time around, the exact opposite. Enough before the election where there's no uncertainty, in fact, complete hysteria, driving Congress into a frenzy like I've never seen. $2.7 trillion in fiscal stimulus already. And they're talking about more. Now, some of this stuff is kind of goofy. Giving every American a $1,200 check, goofy. Having a program where any business can borrow money no matter what, goofy. Giving away money to industries with no oversight, goofy. Some weird stuff in here. But there's some good stuff too. Expanding unemployment benefits, making sure more people have entitled to it, increasing the amount of money people are able to get on a weekly basis, making sure some of those PPP loans are getting to hard-hit businesses. This is all good stuff. In context, people, $2.7 trillion in stimulus. The U.S. economy produces about $22.5 trillion in economic transactions per year. In any quarter, that means $5.5 trillion. They're lobbing $2.7 trillion in stimulus at a $5.5 trillion quarter. Wow. I mean, that's insane. And yeah, that's going to go a long ways to keeping the lights on. And of course, it isn't just the Fed. I mean, the federal government. The Federal Reserve is doing all sorts of stuff to stabilize markets. You have local governments. You have state governments doing things. The IRS says people don't have to pay their taxes yet. You have moratoriums on evictions. You have large public owners telling their large landlords, telling their tenants, don't worry about paying rent. Everybody's getting into the mix. We're actually working pretty well together, which again, will stem some of the problems here. Lots of good things happening. And then last but not least, number 5, are people going to change their behavior? Now, again, the pessimists out there are telling us that everybody's going to be afraid. People are never going to want to go back to a ball game again. People aren't going to want to go outside. They're too scared because this is a new normal. A new normal. Yeah. Anybody ever hear of smallpox, polio, diphtheria, the plague, yellow fever? Anybody, mumps, measles? You hear these things? Pandemics have been with us always. Always. It's part of humanity. Yes, we've been very fortunate for the last 40 years. For the most part, public health has been in front of it. And we haven't had to deal with any of these things recently. But there's nothing new about this. Human beings have been dealing with this forever. And by the way, what's happened in the past? The answer is not much. It's hit, it's gone away, and people have gone out and lived their lives. There's never been a sign of people moving into caves because they're afraid of a virus coming back. They just haven't. So, again, I don't see this being some massive change in people's behavior. And I think that's even truer when you think about it on our own personal basis. While I know the numbers are pretty scary, and let's say 2 million Americans have this. Well, that's still substantially less than 1% of Americans. And that means the majority of Americans aren't even going to know anybody who had the virus, much less have it themselves. So no, I don't think this is all that big of a change in things. So you get into this and you say, okay, and you say 5 questions. How long? 3 to 4 months. How deep? 10% of the economy for now. How healthy was the economy? Vary. What is the government doing? Everything. Will people change their behavior? Probably not. None of these things suggest to you. All these things suggest a very sharp return to normality. Just as simple as that. And as for the stock market itself, yeah, it's down, but it's down in large part because it was a bubble. 3rd highest PE ratio ever recorded on the stock market in January of this year. The problem here with our financial markets is not the virus and the economic shutdowns. The problem with our financial markets is our financial markets are broken. You remember all that stuff you learned in finance class, about how markets are efficient? Yeah, nonsense. These markets are not efficient. They're broken. They're all over the map. They're hyper volatile. It's driven by dark pools and high speed trading and everything else that Wall Street's doing. Financial markets are supposed to be the shock absorber for our economy. Remember, they're supposed to be the place that you go to hedge risk. This time around, our stock markets has turned into a shock accelerator. They're making situations worse rather than better. And that, again, is because of the complete lack of regulation. Finance markets have a big problem. And I hope that afterwards we realize that we need to go and figure out how to make these things yet again become the shock absorber for the US economy, not the shock accelerator. So, Great Recession versus that now today. Then millions of jobs in real estate, construction, finance permanently lost. The financial system pushed to the edge of collapse because of all the bad debt that had been generated over the previous 6 years. This time, you got a couple months of job furloughs on the outside. You don't have any major problems in the financial markets. This isn't the end of the world. Unemployment is up in a big way, but then again, unemployment benefits have never been that generous. Anecdotally, one of the bigger problems out there is employers who would like to bring people back are being told by their employees, no, thank you. I'd rather be on unemployment for a few more weeks. This isn't a Great Recession type scenario, and we shouldn't pretend it is. So no, this is not a U, it's a V. Now, a couple things. First of all, the cure isn't worse than the disease. Don't let this thing pan out. Make sure we get it under control. The idea of squashing the curve, you go from having half the population having it to substantially less than that having it. Ultimately, this is a good thing. A little panic is a good thing. Shutting things down, getting in front of this is a good thing. But now we're over that. We can start getting back to normality. It's okay. But we have to keep vigilant. Don't let this idea that we have to reopen the economy because the damage is too great get into your head. The other thing to keep in mind is nobody seems to be paying attention to the fact that we are blowing out the budget deficit in ways that you can't even envision. The Treasury has already announced they're going to borrow $3 trillion this year, and they'll probably end up borrowing more. To put that in context, as a percent of GDP, that is slightly more than during World War II. Back then, we were fighting a global war against fascism. Today, we're fighting a 2-month battle against the nasty bug. This is not right. And you got to remember that this is occurring in large part because we were already in track to borrow $1 trillion this year. In the 11th year in expansion in a fundamentally healthy economy, $1 trillion. And this, of course, is on the run up to a massive fiscal crisis in the next decade to 15 years, driven by Medicare and Social Security. You know, a number of economists called this virus a black swan event, and we all know what a black swan is in finance terminology. It's an unexpected shock to the system. And every epidemiologist said, excuse me, I've been telling you for the last decade that this is going to happen. And the fact that everybody's so surprised that it happened is only because you ignored us. And that is true. This isn't a black swan. They've been telling us over and over again. Well, guess what? It's exactly the same conversation when it comes to the fiscal crisis that is brewing. Economists have been saying for decades that there is a massive problem. We have to get in front of it. We have to fix the federal government system, its entitlements, its tax system, and we got to do it now. But as opposed to even talking about that, instead our federal government is literally stepping on the accelerator and are heading towards that fiscal crisis as fast as possible. And when that happens, don't call it a black swan event. We've been telling you for decades this was coming. So the long run still matters, people. This isn't the end. Things are fine. Yes, negative Q2, probably the worst ever. Positive Q3, almost assuredly the best ever. Is it a recession? Yeah, they'll probably date it as one. It's very, very deep, but it will also be very, very short. Unemployment, we think back down to 5% by the end of the year, maybe a little over 5%. Moderate upticks in debt distress, stock market, who knows? Impact on real estate or really any kind of long run thing, not worth even discussing. In fact, one of my fears is you're going to see a lot of folks trying to push for long run policy changes on the basis of a three-month virus event. Wrong time to have these conversations. Now, again, I started this conversation by saying you have to approach this conversation with an utmost amount of humility. Yes, there could be a mutated virus which would cause a second round of outbreaks and global shutdowns. Different conversation. The global situation, supply chains, you got to keep an eye on that. Hopefully, the globe is ahead of this as well. We know, of course, that retail and restaurants were already under stress. Retail because of the internet, restaurants because of oversupply. Some of those guys aren't going to come out. Again, it's not because of the virus, but the virus is accelerating a trend that was already in the system, and that is going to slow down a little bit of the recovery. We got to pay attention to the financial markets. They seem to be gung-ho to create a crisis where one doesn't need to exist. Why wouldn't they? After all, if finance markets get to create a nice crisis, they get a nice big fat bailout from the Federal Reserve. Of course, how long till entertainment, people get back up and running? Again, I'm thinking Q3. And as for state and local governments, one of the things, again, I worry about isn't just the federal government, but there truly is a massive fiscal problem here that's brewing. And of course, we're going to come out the back end of this with a whole bunch of problems from local government up to federal government because of the massive amount of spending and the loss of revenues and the incredible amount of borrowing that's going to go on right now. This is hastening a lot of problems that were already in the works, something we're going to have to pay attention to. But even with those warnings to one side, this is not a U. It's a V. It's very clearly a V. Nothing I've seen yet makes me want to change that opinion, and I'm going to stick to it. And also for other guys who are talking about U, well, there's another expressor. A forecaster is an expert who knows tomorrow why the things he predicted yesterday didn't happen today. I'm going to be very curious to see what those UCLA forecast guys have to say for themselves on the back end of this. We'll see. We'll see. So with that, I'll go ahead and wrap up.